Okay, good morning. Let's start. I think a few colleagues will join us later, but let me first thank the organizers, Juan Luis, Javier, and Mark, for putting together such an interesting program with the quality that you have been witness to in the previous session and the sessions yesterday. It's really a big effort, but I think it's paying, so congratulations. Now, let me say a few words of introduction to this panel that I venture will, to some extent, overlap with the previous one, unavoidably, because we heard about cross-border, we heard about foreign exchange. So it's obvious now to all that the massive adoption of digital technologies originated at the end of last century, but now becoming exponential thanks to the hyperabundance of data and the computing capacity out there, and of course, new infrastructures, and think of blockchain and these kind of things that we heard mentioned before. Of course, these, well, most likely and is already impacting capital flow dynamics. So capital flows are not strangers to this disruption. Of course, capital flows are affected by internal factors, as you know, government finance, external debt ratios, and the like. By external factors as well, monetary policy implemented by other countries, and we heard about dollarization as an example, prominent example, global supply of liquidity, risk aversion. And one of these factors, one doesn't know whether to qualify them as external or not, is technology. And when technology changes, of course, capital flows could be impacted. Now, the way to hold money, the way to transfer money from our mobile devices, now it's easy to swap currencies in milliseconds. So, and people can hold various currencies simultaneously at a costless fashion. So digital helps to blur geographical borders and makes it easier to interconnect and to develop payment systems across borders, potentially. So there are three areas here in order to try to put some order in our discussion that I think merit some attention, areas in which digital may impact capital flows. First, is cross-border and real-time payments. And this was an issue also previously. Is one of the areas potentially more impacted. And I understand that a couple of our panelists, at least, will talk about this. Digital platforms, blockchain, and the like create new channels for cross-border capital flows. And the positive side of this is, of course, faster, lower cost, and more efficient international transfers. There is, of course, as always, a flip side, potentially, because increasing volatility or the risk of increases in volatility are there. The relevance of technological resilience comes to the forefront because this all relies on technology. The greater interdependency between players and cyber risks are the risks to watch in this context. The second area that merits attention refers to clearing and settlement of payments and securities transactions and infrastructures in order to execute this. And again, this has positive aspects, of course, because technologies like blockchain may facilitate delivery-based payments in these transactions without the need of an intermediary. But at the same time that we reduce settlement risk, we might be increasing liquidity risks. So one has to watch it. And thirdly, of course, the development of digital currencies or crypto assets are another novelty that may reshape capital flows. And I anticipate that my good friend Jean-Pierre will talk about this, but there are a number of issues that converge here. First of all, dollarization, it was mentioned before, and is quite important. There may be a way out if digital helps the diversification of risk-free assets going forward. The notion of digital currency areas that I'm sure that Jean-Pierre will refer to is an issue here. And of course, the recent proposal that you might have heard by Mark Carney, when thinking about the long term, the creation of a synthetic, hegemonic digital currency, basically a synthetic basket of CBDCs. And there are some central bankers that think, okay, Libra has a number of drawbacks, we can improve upon them, why don't we think about it? And indeed, it would be a game changer for the future. So we have with us to discuss this and of course other topics, because you are free to do so, for very outstanding speakers. You have seen in the program the names. We have Kim Yao Fan, Director of Strategy and Operations, Equitable Growth, Finance and Institutions, the Vice Presidency at the World Bank. Secondly, I referred to him, Jean-Pierre Landau, former Deputy Governor, Banque de France, and now head of the French government with special mission on cryptocurrencies, and on top of it, teaching a science po in Paris, and also with some teaching commitments in Harvard University. Luis de Mello, Director of Policy Studies Branch at the Economics Department of the OECD. And finally, Dan Morgan, Head of Regulatory Relations for Europe at Ripple. And I guess that you have some experience in trying to educate policymakers, so maybe you can tell your take on how is the thinking evolving in connection with cross-border and real-time payments. And in order to create no discrimination, if you have a program with you, because I think I left mine there, I follow the order of the program to be neutral, because there are some speakers from which I know not much of what their planning is. So let's start with Dan as foreseeing the program.
Thank you very much. First of all, a huge thanks to the Bank of Spain for inviting us here today. Obviously, as a private sector representative, to display what we're trying to do. Delighted that the BIS mentioned that cross-border payments was the killer app, because I'm focusing a lot on that today. It's a short presentation to outline who we are and what we're trying to achieve, and then we'll talk about a lot more in the panel discussion around some of the technology and some of the challenges, particularly in a regulatory session after that. So, for those of you that don't know, Ripple is a technology company launched in 2012 in San Francisco. Our aim is to remove the friction from cross-border payments using both DLT and crypto assets. We've got 200 customers in over 40 countries, and we are live today. Unlike many of the proposals you've heard around Libra and other things like that, we are live today with many of our customers. We have a vision to try and create the internet of value, to be able to move money today like information moves. Many of you now, I can see, are on your phone, and don't worry, I'm not going to pick you up on it. What you'll notice that the experience is seamless, and that different networks interoperate together, whether it's 4G, email, HTTP or ICP, they all work together seamlessly for the internet of information. But that is not how payment networks work today. Domestic or regional payment systems are pretty efficient. The growth in real-time payments, real-time RTGS, or more or less real-time, but they don't speak to each other. They're coupled together by a series of corresponding banking relationships, which result in an experience which is very slow, can take many days to settle, is very expensive. The average cost of remittance stood around 7% and can be much greater than that in hard-to-reach markets, and it's often unreliable. That's the failure rate we've got back from some data from SWIFT. The problem is even greater when we talk about low-value, high-volume payments, such as remittances. There are over 270 million people living outside of their country of birth today, according to the World Bank, up from around 150 million in 1990. This market is ever growing. And of course, the growth of small businesses who immediately, due to the proliferation of cloud technologies, can immediately have a global market and receive low-value payments on a regular basis. And then, of course, digital platform businesses, whether you're a trader on eBay or whether you're an Airbnb host, you're receiving many low-value payments, taking a huge amount of fees from each one of these payments using things like PayPal or traditional banking networks. And of course, the session today is on global flows. Remittances have overtaken FDI and private capital and aid as the largest inflow of capital into emerging market economies. Same data from the World Bank says in 2019, them 270 million migrants living in countries overseas will send $689 billion back to their home market. So it's a significant proportion of the world economy which is underserved by current cross-border payments. And it's not just individuals. The growth of small businesses is also driving demand in this space, which are underserved by the current banking networks. As we can see here, double-digit growth in inflows and outflows from South American markets, dominated here by Brazil. And it's against this backdrop that we have a deluge of headlines, of new initiatives from JP Morgan coin to Libra and other stable coins, which seem to appear every couple of weeks, and lots of new projects trying to address some of these issues in cross-border payments. And I don't want to dwell too much on this because we've already talked about it quite a bit at length. But obviously we've got CBDCs, which are obviously mainly in the conceptual phase, but obviously have been around for hundreds of years as well in practice. Stable coins, which we view very much more as things like Libra, with a basket of assets or currencies. Again, things like Tether, which was quite controversial. Again, we would say falls within this bucket. Of course, there's native crypto, which is the one standout there, which is decentralized, and anyone can access it, and anyone can trade in it. The two I've listed there are obviously Bitcoin, which fundamentally is seen as a libertarian project, is looking to try and replace fiat currencies in some respects. Ripple utilize a digital asset called XRP, and our view is very much around connecting fiat currencies. So although they have some similarities in the native crypto assets where the value is derived from the network, not any backing, often their uses and protocols mean they can be significantly different. And then, of course, the proprietary DLT systems, which don't use an asset per se, and obviously permissioned around messaging and settlement and exchange of value. And Ripple, again, use that in Xcurrent, but there are many others, such as R3, Corda network as well. If we think about where we are today, and we think about Bitcoin blockchain as the breakout technology, I think 10 years on, we're seeing a maturity of design-specific use cases. I mention this because Bitcoin blockchain is not suitable for cross-border payments or large networks because of some of the issues around settlement finality, which have been raised by the BIS, some of the issues around costs, and many more issues which mean, although it addressed the issue of digital scarcity, i.e. the double spend problem, which means that the Bitcoin I've sent you I no longer have. It was that breakout technology. We're seeing much more design-specific use cases come to market. Again, with Ripple, we focus on the XRP ledger, which is very much around speed, settlement finality, and reach. So what exactly is Ripple? Well, as I say, we're live today, and it's a network of eventually 2 technology stacks which are integrated. The first is Xcurrent, which is a messaging and settlement layer. Essentially, the open source version of this is a technology called the Interledger Protocol. We see this as the HTTP layer of the Internet of Value, i.e. it's the interoperability layer. It can connect many different ledgers together no matter what they are. So for instance, the open source version of it has been used by the Bill and Melinda Gates Foundation in their Level 1 project to connect different mobile money systems in Africa today. The commercial version that we use, Xcurrent, for financial institutions also has a messaging and settlement system, moving away from file-based messaging to one that's more akin to WhatsApp and can track. And we've seen similar copycats, obviously, with Swift GPI. Essentially, we would say this is much more real-time, where you can track payments from end to end. Much more certainty in the cost as well around it. And as well, the settlement is atomic, meaning all the money moves or none of the money moves. This is our primary product. We have 200 customers today which use Xcurrent. But with this system, it's still bilateral. You still need to pre-fund overseas and maintain relationships with banks overseas. This is probably okay when you're talking about US dollar or GBP or euro, where the cost of that relationship is commercial and the regulatory overhead is acceptable because it's a high volume corridor. But if you're going to go from Brazilian real to Philippines peso, the chance of that being pre-funded are quite low, and obviously you would have to go through a series of corresponding banking relationships, jumping from balance sheet to balance sheet. At each stage of that journey, a cost would be removed. Obviously, many banks in the system would make money out of the float in the system as is. So our view on digital assets is we feel that there's a role to connect different fiat currencies, particularly more exotic currencies where that bilateral relationship does not exist. And in our case, we use XRP as the bridge currency. How do we do that? We do that through the second part of RippleNet, which is on-demand liquidity, or XRapid, where instead of pre-funding overseas, we source for liquidity from digital asset exchanges in both the home and the beneficiary market. Very simply, obviously there's much more complexity to it, it's 2 domestic payments connected by a movement of XRP. So in this instance, it would be USD to XRP at the home exchange, a movement of XRP across the ledger to the beneficiary exchange, and XRP to Mexican peso. The final payout could be over local rails, a direct relationship into digital wallets. On top of that, there's a messaging and settlement layer, which includes the Ripple payment object, which includes all the information you would get in a cross-border payment, KYC, for instance, settlement finality, any other legal issues you may have. At either side of this, there's a financial institution in our model. We're looking to connect fiat currencies, so they will conduct the KYC and all the checks that you would do in a normal cross-border payment. We're not looking to circumvent the system. It's live today. We've had 2 quarters, and we've seen significant cost reductions. This is one of the examples that we have gone live with XRapid, but also quite, you may have seen, we are an important relationship with MoneyGram, again, who is now utilizing Xcurrent as part of their treasury relationship, again, to significantly reduce their costs. Again, so we see primarily the use case here being retail remittances. I don't think we're going to compete necessarily with high volume corridors at the moment where that relationship is there. There are challenges as well, particularly on the banking side, where the relationship, the regulatory environment for digital assets is still emerging. It's getting better. We've talked about FATF before. The Basel Committee is looking at the prudential requirements around how you would hold or have exposure to digital assets. Things like how digital assets can have any exposure to financial market intermediaries, things like settlement finality. These are all starting to develop, and I think larger banks at the moment are starting to look at this in a more serious way. And obviously, as these rules and standards come in, I believe we'll see much greater adoption beyond payment providers globally. So that's it. It's a short presentation. These are some of the use cases that we see today from digital assets and how we try and use it. I think the future is very positive, but what we do need is much greater regulatory certainty.
Thank you, Dan. Now is the turn to Jean-Pierre.
So maybe this late in the conference, I could indulge into doing some science fiction, right? And I would think of a world which is the negative of the world that Jung was describing in the previous panel, with no balance sheet, no bank, and only networks and tokens, right? And so we pay by, we belong to networks, and we pay by tokens. So I think I have an illustrious predecessor in thinking of that world. And here you have a quote by Milton Friedman, which goes back like more than 20 years ago actually. And it's very interesting because he foresaw that world very well. And he foresaw that we could one day have a reliable e-cash method whereby on the internet you can transfer funds from A to B without A knowing B, so peer-to-peer anonymous payment. The way in which I can take a $20 bill and send it to you. Okay. And he even foresaw all the policy problems which would come with it about anonymity, know your customer, and everything. So this encouraged me to do some science fiction of my own. And I would like to wonder, in a world like this, where we have only networks and tokens, what is the map? What is the geography of such a world? Where are the boundaries? Where are the limits? And it's pretty clear, it's pretty clear for common sense that the limits and the boundaries are not defined by a balance sheet relationship or counterparty relationships. They are defined by digital interconnectedness. And digital interconnectedness has two components. First, you belong to the same network. And second, you use the same token, the same type of currency, whether that currency is denominated in its own unit of account or whether it's denominated in an existing unit of account. And the intuition behind this is that people who belong to that network and use that currency have a very close monetary relationship. They trade with each other more easily than they trade with other people. Price transparency is higher, price discovery is easier, and you don't have to convert into a different token when you want to trade between inside the network, whereas you have to convert into a different token if you trade outside. And in addition, as we see the platforms and the money and the networks evolving into consistent system, money is part of a bundle. With money, with the token, you access goods, you access services, you access a lot. So the payment platform is something which gives you access to a whole life. And there is quotation by people from Alipay, for instance, who say we want people to live their life inside our system. It's an ecosystem, right? And so it's very close to what we could call a currency area, and we could call that a digital currency area. It's very different from the currency area from the literature. It has no macroeconomic basis. It doesn't come from the idea that we share macroeconomic shock and that we can dispense from the exchange rate. But it shares the same intuition that it's easier to trade with people inside the area than with people outside. And that's basically at the origin of the concept of a currency area. So the assumption that we could make, and we see that with Libra coming, is that in a world where we have networks and tokens, the monetary map and the monetary boundaries will be determined by the currency areas and by the tokens and the networks. And we will have those digital currency areas. And it's very important to note that they have nothing to do with boundaries as we know them right now, the current currency areas. For instance, in China, you have Tencent, 700 million people, and Financial, 600 million people. The tokens are not interoperable. So these people, in fact, even they all use the renminbi, and they use digital representation of the renminbi. They cannot pay to each other as easily as they pay inside the network. So question of interoperability, for instance, in my view, are going to be at the forefront for regulators, because if they want to avoid the segmentation of their own domestic system into separate digital currency area, they have to think about that very, very closely. And of course, the business case for having special purpose currencies, which segment the domestic system, is very, very strong. Now, of course, they may be also cross-border, and so those digital Libra will be cross-border, and those digital currency area will ignore national border, and they will ignore national domestic jurisdiction, and they will ignore sort of digital the national central bank. So there's been a lot of talk about digital dollarization. It has been discussed up to now from the point of view of the country which is going to be dollarized, right? Let's look a little bit at the other side. Who is going to dollarize who? And what are going to be the international currencies in a digital world? And if we look at the theory and history, there are many ways to internationalize a currency. So the end point is very clear. It's a store of value. It's a reserve currency. But how do we get there? Through which sequence and history do we get there is not that clear. And it's possible to make the case from history and from theory that you may start from being a medium of exchange. And being a medium of exchange, you become an invoicing currency, and then you become a store of value, and then there's a feedback effect between those three functions. Now, if you can internationalize a currency by starting being a medium of exchange, the concept of having a digital network pushing for your use of your currency outside your border becomes extremely attractive. Now, the governor for China is not there anymore, but it's pretty clear that this is the country which wants to internationalize their currency, although he said it's not an objective, but it's still a perspective, and which has very big digital operators. So when we think of dollarization of country, we can think of big currencies becoming digitalized and internationalized for digitalization. I think this was the addition that I would make to everything which has been said about the dollarization. And I agree that it should be a major motive for countries for emerging economies to create their own central bank digital currency. You don't want to be in a situation when you have to compete with a physical currency towards a digital currency which is more efficient in payment and which is coming from abroad. It's as basic as that. And I think this is an overwhelming case for many, many countries to study and to project for ECBDC. Last thing about, of course, is the synthetic currency. It has been mentioned a lot. José Manuel mentioned the statement by Mark Carney. I would never have thought even 2 years ago that I would hear a major central banker talking about changing the asymmetry of the international monetary system by creating a new hegemonic synthetic currency. That's an incredible thing, challenging the dollar by creating a new hegemonic synthetic currency. That's the thrust of his Jackson Hole speech. So that shows you how potent the concept is of creating a digital currency out of token. Because what he's talking about is, of course, a token in a network, and a token backed by a set of portfolio of official currency. So again, this is a very important point. I was surprised that Tobias did not mention that the SDR could be the basket for such a currency, because it comes immediately to mind. If you think of a new synthetic homogenic currency, there is a basket, there is one which exists, and there is one for which the IMF has been very anxious for decades to promote the private use and the official use. So it seems to me that when we start thinking of a synthetic new global currency, we have the private one, and Libra is coming, but the public one, we already have the basis and the basket which is defined. So the basic message here is, again, about maps and boundary, and it's that digitalization of money it's not a certainty, can reshape the international monetary system. It can draw a new border inside our domestic system, and it can wipe out or attenuate the existing border. And for those central banks which are legitimately worried about that monetary sovereignty, defending their unit of account and defending the autonomy of their monetary policy, that should be a matter of big reflections and concern. Thank you very much.
Thank you. Now, Luis, you have the floor.
Thanks. Thanks, José Manuel. Let me start by thanking the organizers for the invitation, the Bank of Spain for hosting us here. Indeed, José Manuel, you mentioned at the beginning that this panel is very closely tied to the previous one, and it's a good thing that this is the case. I'll try to make 3 points. One is connected directly to what was said already or alluded to in the previous panel, which is about, obviously, how technology is changing payment systems, changing settlement systems, changing the nature of financial transactions. And how this evolution has taken place at a much faster pace at the domestic level than at the international level of the cross-border aspects of it. We are seeing over the last decades a lot of change on the wholesale side, for instance, making transactions much faster, much cheaper, reducing risk, all sorts of good things that we've been observing at the domestic level. We are seeing a tremendous transformation in retailing as well, essentially, again, at the domestic level. Dan, you mentioned a few things, the previous panel the same. But the truth is that at the cross-border payment level, we haven't seen that. We still rely on systems that depend on this network of correspondent banks. This adds costs, adds a number of features to those transactions that basically make it difficult for the evolution that we're seeing on the domestic side of reducing costs, greater efficiency, and all that to be replicated at the international level. We are seeing changes in technology. We are seeing the emergence of new actors and all that, namely fintech that started off basically by focus on user interfaces, but now more and more into clearing, into settlement, and so on. So new actors, new technologies. A lot was said before about blockchain, for instance, but also about centralized solutions to the issues that we are talking about. So new technologies, new actors, evolutions on the domestic side, not matched by the evolution in terms of cross-border transactions. What would be the good thing about more progress on the cross-border side? I mean, obviously, is reducing costs, greater efficiency. Dan, you mentioned a case that I think it's emblematic about remittances. I mean, we know how costly remittances are, and if we look at who pays for that, I mean, it's extremely unfair to imagine that sometimes it's the people who have the least means to engage in that type of transactions paying the highest cost for that. But anyway, so how technology can help the current account side of the equation, how it can help facilitate increase efficiency in factor payments across borders. I mean, obviously that's a desired and a desirable feature of all that. Technology, I would say, is not the key element in that. I mean, because we are seeing these very different speeds at which technology is affecting different parts of the payments and settlement system. So there is an element there of regulation and governance. I think, what you mentioned by institutional underpinnings, I would say, well, of a regulatory nature, of a governance nature, that would allow, basically, to remove some of the obstacles that right now prevent greater efficiency for cross-border transactions. The advantages would be obvious, no? For the trading securities, for instance, reducing costs of record keeping, of reconciliation, settlement. Those are all things that would be extremely beneficial and would have a direct impact on cross-border investment flows. So an aspect where we are seeing that technology in payment systems would have probably a repercussion on the capital account as well by making trading securities more efficient. It would open up opportunities for firms, SMEs. Dan, you also mentioned SMEs. People mentioned that before yesterday. I would add another class of firms there that I'll come back to in a minute, which is extremely important. It's innovative firms that basically right now currently rely on internal sources of finance, could, as a result of greater efficiency in all those segments of markets, have access to a more diversified source of finance. Risks, many people have mentioned those. I mean, AML, one comes to mind. counterterrorism financing comes to mind as well, issues of tax evasion comes to mind as well, especially in systems, in solutions that don't allow for traceability as efficiently as the alternatives that are available out there. But I would say also in terms of risks, the challenges that it creates for, again, to go back to the point of a payment system that is still based on correspondent banks. So how can we maintain the integrity of a system, of the positives of that system, as it is challenged by alternative mechanisms. The issue of tax evasion is obviously one that, again, is related to solutions that don't allow for traceability the way that would facilitate the work of tax administrations and tax policymakers as well. So I would say that just to echo what was alluded before, I think there is an agenda for work on that front to make sure that the cross-border aspects of the improvements, the changes driven in part by technology that we are seeing can spill over to cross-border transactions. And let me conclude with a point about let's say that I would call the demand side of a finance. We are seeing this digital transformation in our economies that is changing the nature of investment. We are seeing investment in intangibles growing much faster than investment in tangibles. We are seeing in a number of developed economies, if you take the UK, the US, for instance, taking aside the difficulties of measurement in this, definition and all that, but there is more investment in intangibles than tangibles right now. So what does it mean? Well, it means that the composition of firms that are investing there, looking for finance, is changing as well. And it is changing towards firms that have traditionally faced the strongest frictions in financial markets. So basically a move to intangibles means a move to firms that are typically smaller, more innovative, without the collateral that is needed to access financial markets in the traditional sense. So basically, that change in composition, and due to the nature of how the digital transformation is affecting investment, will have an immediate bearing on international capital flows. What can be, or what are the likely outcomes in this area? I think, well, one is if technology, regulation, governance, these institutional issues we're talking about, facilitate access to external sources of finance for those firms, well, there is a potential gain for efficiency in general, better allocation of resources in our economies, and so on. There are a number of issues related also to the composition of FDI, the composition of, to the extent that FDI is more driven by M&A or other forms of cross-border investment, favoring investment in intangibles. How can we address issues of valuations? How can we address all those traditional frictions that have led to greater reliance on internal sources of finance for those firms in general? What about the emergence of intra-firm trade? We are seeing growing over time, in part because of this, because of the nature of investment that we are seeing, with an immediate consequence also for the composition and the magnitude of capital flows across border that are likely to take place. How can we think even in terms of equity, a shift towards longer term types of equity, which is what those firms are demanding. So I would also say in this whole debate about how technology, how the digital transformation is affecting financial system, let's also think of the demand side, how it is changing the nature of investment and the composition of the demand for finance by firms. And let me take, if you allow me, Jose Manuel, a final point, since we're talking about capital flows, and since we're talking about changes in capital flows over time in ways that are sometimes hard to anticipate right now, there will always be a need for managing capital flows. The OECD, as you know, has the codes of liberalization of capital flows. It's a key multilateral instrument for managing a very broad array of capital flows across its currently 36 signatories. We've been through a process of reviewing the capital, the codes since 2016. Only last May, these revisions have been adopted formally by the participating countries with a number of improvements, with a view, at the end of the day, of making sure that the codes that had not been revised in over 20 years could better reflect the emerging needs of capital flow management, given all the transformations, all the changes that our economies are facing. Perhaps I can come back to some of the key features of those changes later on in the discussions, but thanks.
Okay, thank you. And now, lastly, we have Kim Yao Fan from the World Bank, and I could venture that you will spell the word coordination in regulations. Yeah?
Thank you. Good afternoon, and thank you to the organizers for inviting me here. I'm actually not going to talk about the digital currencies, which I think have been talked quite a lot today and this morning, and frankly, I have nothing new to offer on that subject. What I do like to talk about is actually to bring you back to the central theme of this conference, which is really talking about the imbalances and capital flows. And since I come from the World Bank, my focus is going to be very much on the impact of these capital flows on emerging and developing economies and how we actually manage these vulnerabilities. What I'm going to say is actually going to be extremely boring because they're utterly obvious and you've heard them. But the central message I want to leave with you is that despite all this talk about the impact and influence of technology, which are enormous, there's no doubt that technology will bring tremendous opportunities for us, particularly for developing and emerging economies. But the central message I want to leave with you is this, is that while these technology adoption will obviously add a new element and complexity to policy making. The key elements of policy measures to manage, to mitigate the risks to the vulnerability of capital inflows are actually some of the very old and fundamental policies. And I would argue that in this era of new technology, that focusing on these fundamental policy issues are going to be even more important. Because unless you actually get that right, you can actually be swept away much faster than used to be. So let me say that I think obviously, capital inflows are extremely, extremely important for the growth of emerging markets and developing economies. They're an essential part of source of financing for infrastructure and for other developments in those countries. But we also know capital inflows are extremely volatile and are subject to reversals very quickly. And I was just counting that in the last 10 years alone, since the 2008 and 9 financial crisis, we've actually seen 4 reversals of capital flows. And in fact, I think the frequency of some of these reversals is actually getting quicker and faster. So I think that's very, very important to bear in mind. In fact, I would argue that the emerging markets and developing economies' vulnerability to capital inflow, it's actually increasing because of the policy uncertainties, in particular the trade tensions we're seeing between the 2 largest economies. And I think that has not been helped by the very rapid and very significant increase in debt of developing and emerging market economies, both public and private sector. At the same time, we're seeing that many of these emerging market and developing economies' fiscal spaces have actually narrowed. So these are real vulnerabilities, and I think that these vulnerabilities have been further compounded by the very rapid adoption of technology, and that adds a significant layer of complexity to policy making, and you've heard about some of these risks. And for me, the most important risk is really the amplification of the interconnectedness and, of course, the spillovers and potential capital flow reversals. And there are, of course, issues related to money laundering and terrorist financing issues. The obviously issues related to the conduct of monetary policy. I think you've heard all of these issues, and I won't go into those. And I will simply say that obviously all of these have added to the vulnerabilities for the emerging market and developing economies to capital flows. So what can we do, or what can developing emerging market and developing economies do to mitigate these vulnerabilities? And obviously, the best way to mitigate and manage vulnerabilities is actually to reduce it in the first place. In other words, not getting into it. Now, that's much easier said than done. But frankly, if you look at how the history of many episodes of these capital flow reversals is that it's actually very difficult to deal with it once you're hit with it. Because if you don't get your fundamentals right, you don't have the fiscal space to deal with them when your currencies devalue and the debt to GDP ratios shoot through the roof. So I think really the best way to manage these vulnerabilities in this very rapidly changing environment is first is to make sure that the use of that capital inflow, it's actually growth enhancing and productivity enhancing. In other words, they are really put into good use. Now that's something we all learn in Economics 101, but I think that it's actually fundamental, is to, unless you can actually get to put your capital to good use, that inflow is not going to help you in any way. And second, it's really, and we've seen yesterday, the decomposition of capital inflows. The most stable part of that, obviously, component is FDI. So the second way to manage these vulnerabilities is really to put in place policy that can actually help you to keep the inflows in the country. And that does mean that you need to have policies that are attractive for the investors to invest in and to keep them there, but also more importantly, to make sure that the returns on these investments, risk-adjusted, are attractive so that that capital does not escape or fly. And I think that's really very, very important to keep in mind. And then if you are facing significant vulnerabilities, and we know that usually what happens is that when there are sudden runs, there will be significant devaluation of the currencies, and your debt service ratios go up very rapidly, and your debt burden in terms of your local currency go up very rapidly. Therefore, managing both the level and structure, the terms of those inflows, it's really, really important. Now, I think one of the things that has happened in the last decade or so is because of the extremely low interest rate environment we have seen, is that obviously investors have been looking for high yields in developing economies, and that has I think, contributed in part to the significant increase in the debt levels of emerging market and developing economies. That's not the only reason, but I do think from our analysis, this is a major reason. Therefore, when you are faced with that kind of environment, one does need to be extra cautious in terms of using that short-term inflow. In particular, for a number of countries that have gone to the international capital markets, issued short-term foreign currency debt. These are obviously quite the very high risks associated with those financing. So I think managing your debt prudently is going to be very, very critical. And lastly, I think creating the fiscal space in case that your currency does devalue, so you still have the room to pay your debt, is going to be very, very important for you to manage that risk. And the last point on managing risks is really, I think we talked about that somewhat yesterday, is to really to make sure that you manage your foreign exchange rate flexibly, not necessarily floating, but making sure that that you're not forced, when a crisis hit, to devalue your currency significantly, because that will really create huge vulnerabilities. And at the global level, I think what is also important for developing emerging market economies is to really make sure that we see reduced trade tensions and we see improved policy certainty in the advanced economies. Let me make two final points. One is this point, and that's linked to the issue of technology. So in this environment, what has changed is really, I think, it's the speed and the pace of these changes with adoption of technology. And frankly, that's not traditionally, speed is not known of the public sector, certainly not with policymakers. So I think that presents a significant challenge and requires a very important mindset shift, and that is that I think policymakers need to be much, much more agile and much more flexible in terms of putting in place regulatory policies. What you don't want is if you act the same way and takes 3 to 5 years for you to put in place a regulatory regime, by the time that's put in place, the world in front of you has changed dramatically, and those regulations become obsolete on day one of implementation. So I think that what that also means is that at this moment, frankly, very few of the policymakers, and central bankers included, have a lot of experience in these areas. So I think the frequent and real-time sharing of that experience and knowledge is going to be extremely, extremely important, and learning from each other. And I do think in that respect, the issue of global and international coordination and collaboration, it's very, very important in areas related to settlements, payment systems, and of course cybersecurity, and the broader regulatory framework, including issues on global taxation of digital transactions. Last point I want to make is that even though we're living in a very different world, and there are a lot more complexities created by the adoption of new technology, I do think it's really important that we treat the same risks, similar risks, equally, whether they are created by the old system or in the digital environment. In other words, for bankers, for the regulators, the issues related to knowing your customer are going to be essentially the same, and I do think that kind of risks, whether this is with a digital service provider or a traditional banking service provider, those kind of risks actually needed to be treated equally and in a similar way. Let me stop it here. Thank you.
Thank you. Thank you very much. I'm tempted to be the first to put questions to all of you, but I will steal the time for the floor to pose questions. So these issues of monetary sovereignty and to what extent they could interfere with developments or regulatory frictions. And now you mentioned KYC and privacy was mentioned by you, or you have, I'm sure, a lot of stories to tell when you approach regulators, or this reminder of what to do to avoid the economic devastation associated to capital inflows are very, close to my preoccupations. Right? Let's try to have 2 rounds at least of questions from the floor. So raise your hands if you have questions to put to any of the participants, and maybe we can bunch together a few. José María.
Listening to the whole of the panels today, I think that one of the doubts we all have is, in this new world of technology, how things are going to operate in stress times. I was thinking in stress times from a banker's perspective, but you were mentioning in stress times for emerging markets. What is really very key is that we have little information so far on how the system will work in a stress situation in 2 aspects. Will all these new development, and I'm not targeting you because you are one of the new developments, will they resist a stress situation, which is all this infrastructure, will they resist? Are they bulletproof? And the second one is the challenges for agents, emerging economies. Well, this is going to go faster. Jean-Pierre, you were mentioning that this has the potential of really changing the whole thing. But that change will mean that, it seems to me that the new environment is going to be merciless with any failure in any policy approach that you do. And we have gone through crisis, and we know how difficult it is sometimes to identify real time what is the optimal course of a certain policy. And I'm thinking also in European countries in the middle of the Eurozone crisis. So it's a little bit this reflection. How the system is going to operate under stress? Is the infrastructure going to be, really resisting the pressures? And what about the agents operating, be it governments or private agents?
Thank you. More questions? Yeah, Javier.
Thank you. Thank you. So let me go to the issue of capital flows. So if I understand well, it's a reading that we have this traditional distinction between, let's say, push factors, pull factors. So basically what technology creates is like a much more volatility in these push factors, which is a bit linked to the previous question. So this means that at the end of the day, beyond coordination, which is crucial, so this digitalization technology will clearly impose more discipline on countries to improve on the pull factors. This is a reading, also of part of your intervention. Thank you.
Yeah, please.
I would like to ask, probably Dan, who mentioned remittances, on an assessment of fintech so far on transforming remittances, all the challenges identified in the recent past in terms of cost, etc., that nonetheless doesn't seem to have been really solved so far. So far this morning we heard about public authorities and a regulatory role. Is there a promotion role by public authorities just to in the remittances area, just to foster change in this field?
Thank you. So we may start with Dan. You were addressed twice at least, and then if you want to intervene also, you can.
So on the operate under stress, I mean, you're right. The X-Rapid function that we talked about, it's been live for 2 quarters. So, there isn't necessarily the history to display that today. But what I would say is that the infrastructure and the rules around it are developing to try and open up these new markets which are currently underserved. For instance, digital asset exchanges, which we're connected to through open APIs, open order books there, are today introducing FATF type rules, and we'll be doing, as we go on, most of the ones in Europe are introducing 5 AMLD to introduce more robustness there in terms of KYC and AML rules. But IOSCO as well, the global standard setting body, is looking at how do we look at these new potential type FMI type institutions and bring more rigorous approaches to them, whether separation of certain activities or CPMI type rules around them, around different approaches. So, it's early in the journey, I think, really. Digital assets have been around for about 10 or 11 years, and now we're starting to see institutional interest and adoption and wider global regulators looking at how we can bring in more a risk-based approach to regulating them. So I understand there's definitely potential threats because things will be a lot quicker, but that doesn't necessarily mean it's any more risky, as we saw from 2008 when we had a liquidity crisis, that the current system isn't exactly foolproof, and some of the challenges we raised before around certain markets being completely underserved, the rise in de-risking from correspondent banking is in certain areas completely cut off. Some of these areas still need to be addressed, and technology is a real solution for them, and all the risks are the same as they were before, I think. So new rules will help address that. I think I didn't get all of it, actually, in terms of the question, so apologies, but I think you're talking about there's been a lot of fintech players in the remittance space already, and have they not addressed some of the challenges that exist? Is that what we're talking about? I think a lot of the ones around, say TransferWise, for instance, or others have been that last mile. And the fintech today has been around the user experience on top of the current infrastructure that already exists. So whether they're opening up relationships around the world and pre-funding and then taking the FX risk themselves, but having a really good digital infrastructure for someone to use, where you experience real time. The back end is actually not much different than it was before, and accessing different markets around the world again would be a challenge for some of these firms. So particularly in Western markets, they've taken a large chunk, but I don't think necessarily that's going to be suitable for all parts of the globe, which I think needs more of a fundamental rethink of it.
Okay, thank you. Jean-Pierre. The question how it behaves in the crisis is actually a very interesting one. So there's a technical aspect to it, and I think there's an economical aspect to it, and also an institutional aspect to it, which I think Yoon mentioned earlier. So the economic aspect is, suppose we have a total token-based system. Is it exposed to liquidity crisis? And it's a very interesting question. If we think liquidity crisis come up from counterparty relationships stopping, clearly that's not going to happen in a token economy. If we think liquidity crisis come with people piling up precautionary balances because they want to face an uncertain future, that could come in a token economy, and that would raise, obviously, the question of the lender of last resort that Yoon mentioned. So I think it would be very interesting for those who promoting this kind of reflection to think about the problem of liquidity in a token economy. And then you have the institutional thing. And the one thing we are almost 100% sure, maybe not fully, is that in 30 years there will still be a dollar and there will still be a euro, right? For the private currencies, we are legitimate of asking ourselves the question. And so we are legitimate in asking ourselves whether, if things become really, really bad, they have an incentive to wrap up the whole system and give up. And that's, I think, the kind of problematic you were alluding to. And as long as we don't have an answer to that, mentioning what Yoon said in the previous panel, we have this institutional question, which is very important. important. What is the long-term incentive of a private money issuer? And it's not clear to me that at the moment we have institutions and systems which give us a reassuring answer to that. And that's part of the trust, of course, that we have in public money. We know that they will still be there in 20, 30 years. And at the moment we don't have that assurance for others.
Thank you. Luis.
Yeah, no, indeed. Let me perhaps focus a bit on this question of the stress situations. Jean-Pierre, I think that the key measure is one of the key risks that is the one that you mentioned of the lender of last resort. That is one that would remain in this situation. But as part of the discussions that we are observing in the context of this review of the codes that I mentioned a minute ago, that is partly driven by the specificities of the technological transformation that we are seeing, is that basically needed to clarify much better the macroprudential regulations that can be put in place in that case, understanding a bit better all the currency-based measures that were already foreseen in the codes but needed to be looked at in the context of the pressures that we are seeing now. A lot more from this point of view of building an institution that allows for multilateral management of those flows, especially in a crisis situation, is what about the notification procedures for the countries that are then members of this or signatory parties to these instruments? What about the issues related to consultations with different bodies that look, like the case of the IMF, for instance, that we looking at balance of payments issues, looking at that complement the analysis that is carried out in the context of the codes. What about a better understanding of short-term measures that are put in place to deal with excessive volatility, deal with excessive dependence on foreign currencies in the situation of a build-up of external tensions. So all that are issues that are coming to the fore in discussions that have to do with improving our international and our institutional underpinnings of how to deal with management of capital flows, especially in situations of stress, but also from the economic side of it, understanding the typologies of tensions that we could foresee in situations like that, and the instruments that would be best applicable to dealing with the specificities of each one of these different types of tensions that are likely to emerge in this new context.
Kimia?
Let's just make a couple of very brief points. I think in all of these, whereas we're dealing with potential stress to the system, what is really critical is the quality of institutions. We talked about that a bit more earlier, but I do think it's a point worth repeating. The question on fintech. In fact, at last year's World Bank IMF annual meetings in Bali, Indonesia, the World Bank, together with IMF, launched what's called the Bali FinTech Agenda, which is very much in response to the call from the World Bank and IMF's client countries to help on how to deal with this very rapidly evolving fintech developments in their jurisdictions, and in fact the calls from many of them for increasing international coordination and information sharing related to fintech. It's interesting because we recently did as part of that, we did a survey and of those country clients. And what is interesting is that the top priorities for greater international collaboration, including on the legal, regulatory and supervisory framework, which I talked about, and the payments and security settlement systems and the cross-border payments. I wanted to stress, even though I very much focused on the risks and how to mitigate the risks of technology, particularly in the interaction with capital flows, we believe very strongly in the enormous benefits of technology can bring to development. I think particularly in terms of fintech, for us as a developing institution, I think one of the most visible benefits that fintech has brought is really the potential for financial inclusion by providing the kind of financial services to those who have so far not been able to access those. But it also has huge potential in improving public service delivery. Just think about the social security system or the social protection systems in Bangladesh, where I worked on for a few years. You have millions of these checks being mailed out every month. Instead of doing that now, and those checks get lost quite often, have to be reissued, people have to wait another month to get that. And today, they're actually able to use fintech to actually get that payment to the cell phone, and obviously it's a bank account or an account opened with a postal service, in real time, and you can check the balance there or at any time. So the potential for using fintech to improve service delivery is enormous. And one of the things we're also looking at, obviously, what's called GovTech. Right, so using technology to improve the governance and service delivery in general of the public sector, be it in public procurement, where you can also use big data to look at some of the procurement issues, or simply in delivering the services I talked about, social protection and those pension funds to the pensioners. So there are enormous benefits that come with fintech, but we also know with those opportunities and benefits come also with some of those risks we talked about. It's important that while we try our best to maximize the benefits, we need to be mindful of the risks that are associated with those and try to mitigate those as much as possible so that they don't then result in a systemic disturbance or a crisis.
Okay, we are sharp in time. Mark, I don't know if you want more play or so we are by the program schedule in time. So maybe we may have time to discuss over lunch any pending questions, but let's proceed with this very timely execution of the program.